Good morning. Welcome to another What's Up with the Market, a market status update. Happy Valentine's Day, and to yours as well. Right, we're going to get into this. There's been obviously a big day on the US markets, not in the upside to the downside, so we'll have a look at that. But before we do that, I just need to cover a reminder before we get into the AFSL disclaimer. And the reminder is that none of this analysis is used in either of our mechanical trading systems, SPA3 Investor or SPA3 Trader, and that none of this analysis is used to make any of the decisions in the ASX and US public portfolios or the SPA3 Trader public portfolio. Those two, the SPA3 Investor portfolios are real money portfolios. The SPA3 Trader portfolio is not a real money portfolio. It is traded with live data, but not with real money. And I use none of this analysis that I'm going to do here today for my own personal portfolios. I'm a 100% mechanical trader, and I precisely follow the rules of our systems and have been doing for many, many, many years. I also have to tell you that everything we cover here today is of a general advice nature. There's no personal in advice required that we provide here, and that it is general investment advice, and that you should seek professional advice from a licensed operator with an AFSL that has a license to do so. Right, into that said, let's get into our analysis. Starting off, as we always do, with the Dow Jones, and lots of red everywhere overnight. And starting with the Dow Jones here, we can see there's a big red candle, a big red bar. Opened just below, opened within the bar of the previous day on the Dow Jones. It's important because I'll make that change. We'll talk about that when we get to the S&P500 and the Nasdaq. But importantly here, the Dow Jones is still above its all-time high, so I'm going to keep this black rectangle, dotted rectangle over here to show that we're above the all-time high that was achieved back some two and a bit years ago. The Dow Jones, bottom right, is underperforming the S&P500, which typically happens when we're in a risk-on market. So when everything's positive and markets are rising, we will see the S&P500 typically outperform the Dow Jones, and vice versa when we are in a bit of volatility in a down market. Right, this is the S&P 500. Note the big gap, and that typically would be seen as a breakaway gap, like we had a breakaway gap here to the upside back here in November. And you don't typically see such big gaps in indices, but when you do, you've got to take note. So we are going to take note with this. I'll just also quickly turn on the SPA3 Investor market risk, but you can see that we are some way away from the trailing stop here on the S&P 500. So there's a little bit of gap. There's a leeway here. It's the medium to longer term timing that we've got on here. So we do give it some leeway to retrace. Now, we have no idea how deep this retracement is going to be, and that is what we've got to keep our eye on, is how deep this retracement goes. It's undoubtedly was due. This had gone on for 108 days, about 15 odd weeks, and had been a 21% run-up over the 108 days from October, late October to Monday. So why did I tell you that? Because the retracement was well and truly due. A 21% rise in just over a quarter of the year is we were setting ourselves up for some kind of retracement. Markets can't just keep on going up. They have to have breathers and retracements. Just like if you have a sprint, the faster you try and sprint, the more you're going to have to stop and have a rest. Markets are the same. Whereas slow and gentle, then breathers aren't required as much, and certainly don't have gasp for air like the market has over here. It's probably a good way of putting it. So this retracement was due, and it's happening. Now we have to see how buyers and sellers handle it from here. There was obviously a little bit of fundamental news that came out in terms of inflation in the US, but some spark was going to spark this. It just happened to be inflation, which is the order of the day at the moment. But if it wasn't that, it was going to be something else. And we all know, with the benefit of hindsight, what it is each time, but we don't know in advance what it's going to be. So this is And this just being one day off a top, off a peak, is we're going to see very little evidence to support this, if you like, in terms of the downside, because obviously we've been rallying upwards. But let's go through it nonetheless. So I'm going to go through the indicators that aren't telling us anything at this stage, otherwise, because we're just wasting our time. But the cumulative new high, new low isn't telling us anything at this stage. It's only supporting what was going into this gap on the way down. Nor is the cumulative advanced decline line. You can see just even at the right hand side over here, it was rising, so more highs than lows prior to today's session in the US. Breadth of market, a few stocks have fallen below their 150-day moving average, but a 150-day moving average is a bit of a gap, and we've seen strength going into this. So nothing to indicate there. The strongest indication should come from the US dollar. So this is the US dollar basket of 6 currencies against the US dollar. And what we're seeing here is the US dollar has been slightly rising. And what we've also had is a rising market. So there's a bit of divergence there, because typically they go in opposite directions. So when you see them going in the same direction, as I did say a couple of weeks ago, this is the first clue that we had of some weakness that may come. Either the US dollar had to fall and stocks keep on rising, or the US dollar kept on rising, we were going to see stocks fall, and the stocks were due for a breather anyway. So it was kind of leading into that. And you might even say that some of the smart money were ahead of the game with using this as a sentiment indicator. So the risk on here is still showing. I'm using the smooth indicator here of the relative strength. You can see here that this blue line falling is telling you, because the primary chart here is the US dollar basket is the US dollar index. This blue line falling is telling you that stocks have been outperforming the US dollar. So that's really why we've got this risk on. That's why we have this falling over here is a buy signal. So we haven't seen this turn up yet. So it still might be early days. Remember, this is just one day, so let's don't run for the hills just quite yet. The Russell growth v Russell value. This is showing bull market territory. Growth is outperforming value. The risk on, the smooth version of this relative strength line, is showing risk on, and this is the S&P 500 down here as well. So this, I'm just going to get rid of these markers because I don't need them now, is still showing that the case for being long stocks. This is the consumer discretionary versus consumer staple. Similar story here. This is risk on, although we do have a buy signal, so we do have an open trade, if you like. If you were trading the spider, the XLY, is that you would still be in this. And now we're going to start seeing some other evidence here. I'm just going to zoom in. You can see this is a green bar. Even though there's a gap down here, it's a green bar, meaning that the close was higher than the open. Now, this is what's a bit confusing. If you have a look through some of the large cap stocks, you'll see a lot of that where they gapped down, but then closed higher during the day. So, but you've got to go, the weight of that would be, you have to give more credence to the gap and the fall than you do for the close being higher than the open. But that's just a little bit of a green shoot, if you like, in this one day that we've had this big fall. So what is that telling us? Is there maybe been a bit of overreaction if there were buyers coming into the close? Let's talk a bit more about it. But this relative strength over here is showing clearly that consumer discretionary is outperforming this consumer staple. Right, this indicator, this is the first indication here of some negativity the day before. You can see I've got a red dotted line here. Why is that? Because this smooth, sorry, I'll just go down and go back up one, is you can see that the blue number here, 10.02 on the right, it's ticked up above 10, coming out of the blue zone, which is an indication that the puts are starting to outweigh, the buying of puts is outweighing the buying of calls, which is a bearish sign. So maybe some people starting to cover starting to hedge their bets. And that is what is showing up in this indicator over here. So this is the put call ratio, and that is the first bit of sign of negativity, if you like. So we effectively back similar to what we had here in August 2023. And you can see that this is the S&P 500, that it went through a period of weakness over there. That's the first negative sign we've had. Sorry, I should say second, because the US dollar was warning us a couple of weeks ago. Right, what's happened here? We've seen a big jump in the yields. This is a Treasury note. So we have had the big jump in the yields means that you're going to see a fall in bonds, which you have a look at TLT in the next chart. But this risk on over here, you can see that this relative strength is starting to rise here, which means that so this is relative to the S&P500, that the yield is starting to outperform stocks, which means that from the bond to equities ratio is that this is another sign that there's going to be some weakness coming. So this blue line is starting to tick up here. The moving average hasn't started rising yet, which is why this indicator here showing risk on is still positive, if you like, for stocks, because we don't just react on one day. But this is another sign of potentially some weakness to come. This is the bonds to equity ratio using TLT, which is a 20-year Treasury bond. And typically what you see here is that the bond price and stock prices tend to go in the same direction, but yields and stocks go in opposite directions. So here we've had some divergence where we've seen bonds falling, stocks rising, and typically over the long term, and it's not a 100% correct indicator, but there are times where they go in opposite directions as well. But just in the short term, a little bit of an indication there that so what happens is stocks going to follow bonds, or bonds going to follow stocks. We don't know in each situation until we get there. But a little bit of that divergence showing that one was going to happen, one or the other was going to happen, and it's equities falling, which were due because we'd had that 21.7% run up in the S&P 500 in just 15 odd weeks. So the VIX, you'd expect to see a big jump in the VIX, which is measuring volatility. Downside fall volatility means VIX rises. So this is all happening in unison for this one day. Right, this is the Nasdaq Composite. What we have been seeing here leading into this is the Nasdaq as a sentiment indicator. When the Nasdaq outperforms the S&P 500, that is a risk-on environment. And you can see that this blue line showing over here is that the Nasdaq Composite has been outperforming the S&P 500. We've had this risk on back here since February of 2023, and despite that period over there where all stocks fell, the fall in the S&P 500 was about the same to slightly less than in the Nasdaq Composite than the S&P 500, which is why we didn't see a sell signal, a fall in the SIRA in this period over here, because the outperformance continued even in the downside. We've had the strength coming into here, just a little bit of an exit over there and back in. There's the all-time high on the Nasdaq Composite. The S&P 500, I won't go back to it now, it's still above its all-time high. It got above 5,000 for the first time in its life. But here's the little bit of confusion that we're seeing is that this bar over here opened low and closed higher. So we had buyers coming into the sell, but into the close, but there was a big gap on the way down here. So that's whereas we didn't see that on the S&P 500. There were sellers going into the close of the stocks, the constituents of the S&P 500. Now, if you go and look at some large cap stocks, their bars will look pretty similar to this, where open lower, closed higher. And what is that telling us? Well, we should give more credence to what happens at the close and the open, but this gap, in my view, is just a little bit too big for that to outweigh what happened in the close. But of course, we don't know what's going to happen, nor do we need to know what's going to happen. It's just an indication of some confusion, if you like, and people not really. Some people took the news, the fundamental news of inflation on the open. There was already a whole lot of strength. There were people looking to take profits. Big gap down on the open, and then there may have been a whole bunch of traders, institutional traders and the like, who thought, "Hang on, this is a bit overdone. We're going to get in." How do we know it's going to happen? We don't. It'll play out over the next couple of days, maybe a couple of weeks, to see who gets in control here between buyers or sellers. But we can't ignore the gap that happened. Here's the same on the NDX, the Nasdaq 100 gap down. There's the green bar, more buyers into the close, and certainly we are seeing this confusion in this index as well. Nothing to really learn from the Nasdaq cumulative new high, new low. One day is not enough for that to come into that, nor for the advanced decline line on the Nasdaq 100 as well. So we'll skip through those. Nothing really to be able to glean from the number of stocks in the Nasdaq 100 above the 150-day simple moving average. So we will get past that. It's up at levels that you expect because of the growth that we've had in the rally that's run up. Right, this is the semiconductor sector. What we've had running into today's session in the US is the strength. So what we are measuring here is a sector, if you like, of the Nasdaq, which is the semiconductor industry group, and I'm measuring it here against the Nasdaq Composite. And you can see this blue line rising, which is telling you that the semiconductor sector is doing better than the overall Nasdaq. And so there's a part of it, and that's really a strong indication of risk-on type equities markets. And that's why we've got the green over here, that this is a smooth indicator of the relative strength line. And we've only had a small tick down here, but there's that same thing. So what's happened is there's definitely been buying into the close on semiconductor stocks. So again, an indication to some of the confusion, big red down bar on the Dow, a gap and a down and a lower close and open on the S&P500, no gap in the Dow Jones, but then gaps in others that have finished with green bars because the close is higher than the open. So that confusion is certainly in there. The All Ordinaries just doesn't have today's data, but we can see there's some weakness happening. All-time highs. So the All Ordinaries has touched the all-time high. The Nasdaq has got just within of it and fallen away from it now. So we don't have all of the indices above their all-time highs. So here we've seen, when we see that the All Ords underperforming the S&P500, that's what this relative strength chart is over here. That's typically a risk-on environment. And why? Because the All Ordinaries, the Australian market, will typically have less downside volatility than the S&P500. You can see when we had this down market over here, this was going sideways, even at times slightly up. You could actually say that from there to there, it was up. So that's typically what happens in down markets, slightly less volatility in the All Ords than what we have in the US markets. But in a rising market, we typically have less upside volatility, and hence we underperform to the upside. The Australian dollar showing weakness against the US dollar. The strength in the US dollar would obviously come on the back of weakness in equities. And so that's certainly in a downtrend. Right, sectors or indices, international indices we want to look at is the Nikkei. This black line up here is the all-time high of 38,915. And we are within 1,000 points of that all-time high that was achieved all the way back in 1989. I did have a bit of a break. I put a black rectangle here as I typically use black dotted rectangles as all-time highs of the recent, if you like, because that goes back all the way to nearly. I've got my chart set at 25 years, not all data, but that coincided with some strong. It can't be strong because I've got a dotted line. Previous resistance area, and that resistance area formed here, and you can see how many times the Nikkei tried to get through it, and then it's burst through it, and it's burst through it with strength. So outperformance here on the bottom chart of the S&P500. So Japanese stocks have been one of the strongest in recent times, and certainly over the last month or so, definitely one of the strongest markets around the world. How do you trade it? There's an ETF, EWJ, but then unfortunately, if you're doing it from Australia, has two exchange rates in it, one from Australian dollars to US dollars, and then US dollars into yen. So it's not easy to trade to take advantage of this sitting here in Australia or even in the US, because there's also still exchange rate variation that happens in that ETF, which is run and managed in US dollars in the States, unless you get direct access to Japanese stocks. But why am I talking about this and making a big noise about it? Because when markets approach all-time highs, particularly ones that are 35 years old, it's big. It's a big thing, and it does lend itself. When I started learning this game, it was the Nikkei was huge. It was one of the big indices. It's one of the ones you looked at. You looked at from an international perspective. You looked at the FTSE. You looked at the Nikkei, and of course you looked at the S&P500. And the FTSE and the Nikkei have fallen by the wayside as being major indices over the last 20, 25 years. and we focus so much on the US, and now we focus on China. But in my view, this is a developed, mature market. This is run as and has been for decades. And in my view, that's not the case with the Chinese market. And it may just be time that the Nikkei starts getting far more credence than what it's been given over probably the last 10 or 15 years. So keep an eye on it. We're going to keep analyzing it. But it's exciting when major indices approach and make new all-time highs, and we should be giving this more credence than what we do. So let's see what happens with this and see what happens with other indices over the coming weeks and how they react to the strength in the Japanese market. The DAX is still above its all-time highs, and that dotted line over the black dotted line, not making much headway. Looks like it's going to come back and retest the support zone now. And it is underperforming the S&P 500, as we can see in the bottom chart here. Right, FTSE, nothing to write home about there. We'll end the indices there and go across into commodities. The CRB index is struggling to make headway. It did break out of this downward channel, underperforming equities. So commodities underperforming equities is really what we take away from that. Gold still bouncing off the ceiling, struggling to get through that all-time high. And you know my view on this, that it's not going to do that until we actually get into a secular bear market, and this will be one of the early signs that maybe that secular bear market has started. And what will that sign be? Well, it'll be a strong breakout above this black zone I have over here, which is a pretty strong resistance zones, resistance area, and gold struggling to get through it, and also not too much strength in the session. US stocks down, gold down, going into the dollar. Typically what's happened. So this is this doesn't, on the positive side, it's showing us that this is potentially not going into secular bear market territory. So as long as gold, we'll really take note of gold when it gets above that black rectangle, and until then we'll just keep an eye on it and keep repeating the same thing until it happens, because it's going to happen at some stage. I just don't know whether it's going to be in the next few weeks, months, or even years. Silver, nothing to really learn from that. Copper, nothing to learn from that, except it has broken out of this big downtrend that it's been in for some, about 2 years. And it needs to find support. It is having lower highs. Days outside of above this upper channel line here, that is positive. It really does need to break out above 400 for that to pass into the small cap stocks. Oil is at a similar breakout of a downward channel, but going sideways, still on support there. Needs to stay above that channel line, that upper channel line, which it just has, but no strength there at the moment. Bitcoin has been quite some strength. It's found support at this support zone here. A new entry signal, not a mechanical entry signal. I've just got these red and blue lines here on crossovers on the 26.9 on the Ciroc directly of price. And you can see that the blue line here is telling us that Bitcoin is outperforming the S&P 500 gold ratio, which we looked at. That's the Bitcoin to gold ratio. We've got divergence here. We can see that Bitcoin is rising, gold is falling. There is a bit of a correlation there. The red trend line show when there's divergence, and the black show when they're going in the same direction. And this is what a customer raised with us, that there was some correlation between gold and Bitcoin, and it is worth having a look at every now and then as another input. But you can see Bitcoin really has outperformed gold for most of the time, but there are times when gold, this blue line falling, outperforms Bitcoin. Well, that's obviously going to happen because it is a far more volatile instrument. But that divergence is worth noting, because at some stage they will come back into sync for a short period of time. Which one will go? Will gold rise or will Bitcoin fall? Keep your eye on that. Ethereum also rising again. It hasn't been as strong in terms of the bigger picture and breaking through its support, its resistance zone, but in an uptrend as well. Right, just last couple of commodities. This is uranium, very, very strong. Just going back to top left, you can see it's approaching all-time highs that we have data for, and getting to the top of this channel and outperforming the uranium ETF quite strongly. So difficult to get access to this except through stocks, and they would be a lot more volatile than the price. The iron ore chart has come down to support, which we noted a couple of weeks ago. It does need to hold support at that 125 level, quite a strong support resistance zone. And thermal coal also down at support and meandering between this upper resistance zone and lower support zone, does need to hold support at 120. All right, are there any questions? There have been. Right, there's been some discussion. Right, John Master, okay, I'm connecting. Okay, all good. That's just problems of the webinar. If there aren't any questions there, I'm happy to hold it, to end it there. But just in summary, the S&P500 did have a big down bar, big gap, and it did rise into the close, but didn't quite get above where it opened, giving that red bar. So too early to tell, but this could be the start of a little bit of volatility. Does that volatility turn into what we had back here, where we had about 3 months of bear market, lower lows or lower highs? Or is it just a one-day flash in the pan because of the close, the strong close? Well, we're going to see that over the next few days. So keep watching, keep an eye on your stocks from the people who are following this, that trade mechanically with our systems. Stick to the exits. There's still quite a lot of leeway. In fact, I'll just mention that pretty quickly. Is that on the Australian public portfolio? I'll just go to here. You can see that we've got. Oh, sorry, it's that one. We've got 24,000 open trade profit, and we've got 12,000 open profit at risk, so about half. So that's telling us that if the market fell to all the stops and all the stocks in the portfolio today, we'd give about half of the open trade profit back, which is, and if you look through all the public portfolios, that is the case. So there's some leeway between where the stops are and where the stock prices are at the moment. But don't get sucked in. This is where you've got to follow the system, because they may not go all the way to their stops and reverse up and continue this trend. So we don't know what's going to happen, and anything can happen. So let's stick to our rules and keep trading mechanically. I'll end there. Thank you for your time. No further questions, and we'll have this recording out soon, and we'll be back in a couple of weeks' time. And sorry, I should say, I wish you consistent, objective, and peaceful investing.